Hello viewers, I'm delighted to welcome Dr. Joseph, Head Research, Emkay Wealth Management. With the ever-changing landscape of global markets, Dr. Thomas' perspective is invaluable. We are excited to delve into his insights on current market trends. Welcome, Dr. Joseph.
Thank you very much.
Shall we begin?
Sure.
Oil prices remain subdued. Any directional change expected in oil prices in the near future?
Yeah, oil prices, Brent is currently at $73 per barrel level. It has come down all the way from around $82 per barrel level. Now, it has come down mainly because of two factors. The first factor is that the US has almost become self-reliant in terms of its oil requirements. The daily production has touched an all-time high of 30 million barrels per day. The second factor, which is depressing oil prices, is the absence of a major chunk of Chinese demand for fuel. Because usually, when the Chinese economy grows and there's a lot of activity, there is good demand for oil from India and China. But the Chinese demand for oil is missing. These are the two factors which are putting some pressure on oil prices. We do not expect any major directional change in oil prices. It may remain subdued to soft. And the range that we had forecast some time back was $75 per barrel to around $80 per barrel. One factor which could give some support to oil prices is the likelihood of a weak US dollar once the US interest rate cuts start happening.
What are the prospects for gold prices in the immediate term? What are the fundamental factors affecting the gold?
Yeah, as far as gold prices go, it broke through the $2,500 mark and touched the $2,600, and it has gone even beyond that. But it's currently hovering around the $2,600 mark. For a long time, some of the estimates by analysts and forecasts had put the gold price target at around $2,600. We believe that the $2,600 rate or 2,600 mark would remain a kind of a pivot around which it could move for some time. Like in the case of oil prices, the gold prices also are responsive to US dollar currency movements. If US dollar weakens on account of Fed rate cuts, the gold prices, just like the oil prices, could gradually move up. That is one of the things which oil prices and gold prices are extremely dependent on, the state of the US dollar. If it's weakening because of the declining dollar, the price could move up. That is the only reason why gold could move up, a declining dollar. There are one or two other factors which have offered some amount of support to dollar. The most important among those factors is the central bank buying of gold. Central banks have been buying gold, but we have not seen any rise in the quantum of buying. The quantum which central banks bought year before the last and the quantum which they acquired in the last year is more or less the same. Therefore, the same amount of demand could come into the markets, and that could support gold prices. Therefore, there could be some more pickup in gold prices, but it is centrally linked to the movements in the US dollar and not any other factor.
Domestic inflation is lower now compared to the last 3 months. Do you expect further gains in inflation?
Inflation, both core inflation and headline inflation have come down, and that gives a lot of comfort to the Reserve Bank of India that inflation gains are there in terms of what they have been expecting. And for RBI, the target range is 2 to 4%, and both core and headline inflation they have come down below the 4% mark, which RBI has been looking forward to. Now, this should give some comfort to RBI that inflation has come down, and probably they could look at changing the policy stance. But is the inflation gains sustainable? That depends on two factors. The two factors which have been quite prominent in influencing domestic inflation have been, the first is the prices of food items, especially fruits and vegetables. Post monsoon, those prices could come down further, and also we might have a good crop of cereals and grains and all that. Those things could exert a favorable influence on the price level. A second factor which could help inflation sustain at lower levels is the lower Brent oil prices abroad. We expect oil prices to remain subdued. Broad range could be around $75 to $80 per barrel level. That will also be useful for the domestic economy in terms of inflation gains. Therefore, we can expect inflation to remain maybe subdued, and we could make further gains in the coming days.
Equities are making new highs every time. What are the fundamental factors supporting equities?
Yeah, equities have been doing very well, despite some corrective downward movements once in a while to the tune of about 6 to 7 or 8%. Why equities are supported even at these higher levels and why it's able to move up is because of the first and most important factor for the equity markets or equity market performance, that's liquidity and interest rates. That's the first set of factors which is good for the equity markets in any economy, any part of the world. That's the fundamental factor which supports equity markets. As far as domestic economy is concerned, the liquidity is very good because the liquidity dynamics have changed. Earlier we used to depend a lot on FII flows of $100 million, $200 million or $1 billion. Now that has completely changed. Our reliance on inflows from abroad, from overseas investors, is less significant today compared to what it was maybe 5 years back. This change in liquidity dynamics is on account of the fact that because of increased financialization and digitization, there is a lot of money which is moving into the equity markets through systematic investment plans, through mutual fund route. So every month we receive close to $2 to $3 billion equivalent of rupee funds into the equity markets. So the liquidity dynamics is supporting the equity markets. The outlook for interest rates is that with gains in inflation and inflation coming down below 4%, RBI's target level, it has come down below that, it's highly likely that RBI will go in for interest rate cuts, maybe in the October policy or in the subsequent policies, because there is sufficient space for RBI to cut the interest rates. That could also be very helpful as far as the economy is concerned. The third but most important factor is that the rate of growth of the Indian economy is quite robust. As per the RBI projections, it's put at 7.20% for the current year. Our view is that the Indian economy is structurally tuned to grow at around 7%. It could be 0.5% this way or 0.5% that way, but 7% would be the central rate around which it could move. And it's a very robust rate of economic growth and probably the highest in the world. So the economy is quite robust. It's structurally tuned to grow at around 7%. Itself affords a very good support for the markets because earnings growth is closely linked to the rate of growth of the economy and not anything else as such. The GDP growth is better, then the earnings growth also would be relatively better. Therefore, these factors afford a lot of support to the markets. Yet another factor is that the the public capital expenditure, or public capex, which the government expended in the last financial year was 10 lakh crores of rupees, and for the current financial year it is 11.10 lakh crores. So the public capex, which helps crowding in of private capex. One of the recent reports from the RBI states that there is a crowding in of private capex, is that which is already happening, which means that if the public capex happens to the tune of 11.10 lakh crores in the current financial year, that will also be very helpful for the equity markets, because that money goes into major companies and from the government departments and ministries it goes to larger companies. From the larger companies it goes into downstream companies in terms of sourcing of components and parts, etc. So it benefits a whole lot of companies, and we expect that to be a major instrument helpful and supportive of the markets in the current year too. These are some of the factors that are very good for the equity markets. So we should look beyond short-term fall or decline in the markets. Could be 6%, 7%, maybe 10% fall in the markets. We should look beyond that and build up a portfolio for the next 3 years or 5 years. That should be our approach, based on the fundamental fact that we have a robust economy.
Do you expect the foreign institutional investors to return to domestic equities? What would prompt them to return to emerging markets?
Yeah. So far we have seen foreign institutional investors moving away from the domestic markets. But once the rate cuts start happening in the US, the Fed rate cut starts happening, we expect a lot of monies from the US to leave the shores of the US, and those monies would target high risk, high return investments in the emerging markets. And in emerging markets, it's the emerging markets equity. And we expect those monies to come into India too. Though as per some reports, the destination of such monies is put as Japan, China, and then India. So we expect FII monies to gradually move into some of the emerging markets, including the ones which I have just mentioned, as the Fed rate cut starts happening. So we could expect FIIs to come in at that point of time as rate cuts start happening.
In terms of market cap preferences, what do you suggest for investor portfolios?
In the investor portfolios, say for example, if you are looking at the small cap segment, it's quite expensive. The valuations are quite expensive. Therefore, it is imperative that we look at companies who are still available at good companies, which are still available at reasonably good prices. That is very important when it comes to the small cap segment. As far as the large cap segment goes, the valuations are quite reasonable and quite close to the long-term averages, and so one could be looking at the large caps because there is immense amount of value even in that segment. Then we have the mid caps, and in the mid cap segment, the valuations of course are relatively more expensive compared to what it was maybe a year back. That's also because of liquidity moving into mid caps and buying up the stocks. But that's the segment which could afford us much relatively higher growth, and there has been a significant amount of market cap expansion in the mid cap segment. Therefore, when the FIIs would return to the domestic markets, they could, in addition to the large caps, could target investments into mid caps also, on account of the expansion in the market capitalization over the last 1.5 years. So in terms of preference of market caps, it should be large caps and mid caps and then small caps. When it comes to small cap investments, one should be entrusting that task to a very good fund manager who could pick up stocks which are worth buying and then set up a portfolio like in a PMS or an AAF. In the case of large caps and mid caps, one could be looking at even mutual fund schemes as also maybe some of the PMSs which have a large and mid cap orientation.
Dr. Joseph, this is a very interesting question for us. Could you give us an overview of the ENEF model and explain how it helps investors make well-researched, informed decisions in today's market environment?
Yeah, the enhanced efficiency model has a track record of 2 decades, and it has done quite well in terms of the efficiency with which we have been able to pick up investment avenues for investor portfolios. Basically, it's a parameterized scheme selection model for the mutual fund investments. The mutual fund, we do our selection of mutual fund schemes for recommendation based on 2 sets of parameters. There is 50% weightage for return-based parameters and 50% weightage for risk-based parameters. So we bring together about 10 to 15 parameters which belong to either returns or risk factors, and then we run the model. We run the model every month, and then we have a comprehensive scoring of the mutual fund schemes. And in selecting the best mutual funds, this model has worked quite well. If we go by the historical performance, because those schemes that we pick and choose to be recommended to investors, they have stayed on in the list of recommended funds on an average for about 2 to 2.5 years. We might see some deterioration in performance only after that time period, maybe 2.5 to 3 years. We might see some deterioration, maybe in 1 or 2 schemes. That's it. Therefore, it's a quite efficient way of selecting better performers for portfolios from the mutual fund space.
Based on your experience with the ENEF model for various asset classes, which asset class has been consistent performer for portfolios?
See, that depends on, because when we advise investors, we advise them on multiple asset classes, because the composition of investor portfolios vary from investor to investor and entity to entity. Therefore, a component of equities, a component of fixed income, some small component of gold, etc. will be there in almost all the major portfolios. But in terms of performance that beats inflation and which would be very good over the medium to long term, nothing can beat equities. Therefore, even at this point of time, as I mentioned to you earlier, we have a robust economic growth and also other fundamental economic factors which support the markets, and therefore it makes immense sense looking at a higher composition of equities in the portfolio, because that alone can actually beat inflation. But we should not overlook the importance of some component of fixed income as a tactical allocation in the portfolio, maybe into gilt funds or some of the Government of India bonds, as a tactical allocation to gain from the portfolio maybe over the next 12 to 18 months as well.
Indeed, insightful views on today's interview. Thank you, Dr. Joseph, for being on the show.
Thank you very much.
Thank you, my friends, for watching today's interview. Good day.